You know, a lot of my technician friends often refer to the bullish sentiment in the market and say, well, Neil, just look at the charts. That's a chart that goes back to the beginning of last year when our boom back after a horrific year came on and took on considerable steam, and it continues to this day. But Robert Prechter follows things a little bit differently than you and me, and he's an iconic figure because he does. He accurately predicted the 1987 stock market crash. And when it looked like stocks had really bottomed out in early December, I should say early 2016, he said, you know what, this looks like a good time. The Dow gained about 20,000 points from that moment. So he can catch you in both the bearish and the bullish moments. Kind enough to join us right now. Robert, good to have you.
It's great to be back, Neil, and congratulations. Your voice is mellifluous. It's not hoarse anymore. You're back in the saddle, man.
I don't know. Good drugs, I'm afraid. But, Robert, let me ask you a little bit. A lot of people don't understand the whole wave theories behind what you do. You would kind of nicely describe them that, in other words, events don't shape moods. Moods shape events. Now, obviously, you've written more than a dozen books that explore and explain this more. But where are we in this whole mood thing now? Because a lot of people are very, very bullish. The VIX index, which measures volatility in and out of record lows. So if we're anxious, we're not showing it. Even in the face of what could be a wider Mideast war, we're not showing that either. Is that too much giddiness for you?
You're exactly right on the VIX. We're going to talk about that as well. I think markets move, especially the stock market, on waves of social mood, waves toward positive and toward the negative. And the positive gives you more optimism, the negative gives you more pessimism. And if you can measure extremes, you can get a pretty good idea of where you are. Now, I haven't been on television for quite a few years because there hasn't been a whole lot to say. 21 was exciting, but right now I think is a really cool juncture. And for example,
what's cool about it? Because from what I'm reading, it's a little scary, but that you're saying or seeing.
Yeah. All right. Well, extreme optimism has consequences. The last time we saw extreme optimism was late 2021, and that's when the broad market topped out and the blue chip indexes temporarily topped out. But look at some of these things. We have right now 2% cash in mutual funds. Now, that is extremely low. It used to be when you got to 4%, it was a bearish signal, and now we're at half that. What does that mean? It means that mutual fund managers can't imagine the market's going to pull back to give them a chance to buy. They want to be fully invested now. Investors Intelligence reports that advisors are the most bullish that they've been since 2021. The average stock exposure among money managers is 100%, was briefly above 100%, which meant they were leveraged. As you mentioned, VIX is low. It has been low for a long time. And on a near-term basis, something interesting is going on in VIX as well. And that is the market, or at least the Dow and the S&P and the NASDAQ 100 have been making slightly higher highs, but the VIX has been backing off a little. Now, previous peaks have had that event every single time. When it happens, it doesn't necessarily mean the market's going to turn, but when the market's ready to turn, that's what happens.
Now, you particularly cite maybe the over-giddiness, if there's such a technical term. When it comes to the NASDAQ 100, that's in an atmosphere of its own. What's going on there that worries you? Because a lot of people say, well, the earnings will catch up to the great potential there. And I heard that before, granted, but what are you worried about?
Let's look at a couple things. First of all, the Magnificent Seven, I think it's down to 6 now that Tesla's down by half, yield virtually nothing. Half of those stocks have no dividend at all. The S&P has a dividend of 1.5%. But you can get 3 times that, more than 3 times that in a treasury bill. So people are betting on higher prices. They're not saying, I need income from stocks. And they've been richly rewarded
for doing so, right?
They have so far, but you know, in order to capture that gain, you have to eventually sell. So they'll have to decide when to do that. I'm actually an advocate right now of safety. I think this is one of the most safety has rarely been so attractive. You can get almost 5.5% for doing nothing at no risk. And there's so much risk in the stock market right now. We've talked about some of the sentiment indicators. I'd like to talk about some of the momentum indicators as well.
Sure. Tell me about that.
Well, you mentioned the NASDAQ 100. The NASDAQ 100 is at a new all-time high, but the NASDAQ composite is not. So even within the tech sector, which everybody loves, the leadership is extremely narrow. We've got a new high, for example, in the S&P, and other indexes aren't following suit. For example, the Russell 2000. Russell 2000 is a broad index of small and mid-cap stocks. It's still down 20% from its high in 2021. Now, some people define a bear market as being down 20%.
But maybe
so
this
the
is a
average stock
catch-up
across the
time that
board
they
is
will
just
catch
down in a
up.
bear still.
I'm sorry, Robert, I jumped on you rudely there, but maybe
that's okay.
The bulls are saying, well, it's just a matter of time before they do catch up, and they're clawing their way back, and they will do that, and this market will be confirmed, you say?
The Russell's been struggling. People haven't seemed to notice, but it topped on the 27th of December, if I recall, and that was the same day the bond rally topped out. So even short term, that little surge we got in the secondaries hasn't followed through. Consider another massive divergence going on, the new high in the Dow Industrial Average. The venerable Dow theory goes back over 100 years, and it said if for a healthy bull market, you need both indexes, the industrials and the transports, to be moving in the same direction. The transports are below their high of December, which was below the high of last July, which was below the high of 2021. So you've got a non-confirmation, a Dow theory non-confirmation at 3 degrees simultaneously. Now, they're right. They could be overcome, but right now it's a signal that's saying the participation in the market is extremely thin. You have to go back to like 1972 when the Nifty 50 were running the market to see anything like it. And I don't even think we have 50 stocks that are leading right now.
So let me get your take on where we're going, because there are a lot of people who look at this and say there are a good many people who are leery of these markets, a plurality for sure, nothing like it used to be. But this is an election year, presidential election year, almost always good for the markets. You think beyond that, though? When are you saying we run into these problems?
Well, all I'm trying to do now for your viewers is just describe the current environment. It's not the kind of environment that I like to look at the long side. We talked about early 2016, in January, February 2016, the market had a pretty mild pullback, but there were a lot of indications of short-term panic. We haven't seen anything like that. We didn't even see that back in October 2022 when we made a bottom. The market's been complacent for years. It's held up a long time, but this is the thinnest market I've ever seen on the upside. Doesn't mean it can't go a little further, but, I'm not suggesting anybody take a risk here. What I'm saying is, why play when the cards have moved from one side to the other and seem to be stacked against the long-term bullish outlook? Short-term, anything can happen, but I'm frankly just not interested in being long stocks right now. I think we're going to have a great buying opportunity whenever the market decides to give us one.
All right, so when will that be?
One more thing,
obviously, you're looking for something, it sounds like akin to a crash, but I don't want to put words in your mouth. What are you saying?
No, I'm not going to say anything like that. We have opinions in the Elliott Wave Theorist. We follow cycles, we follow wave structures. But, I only get to talk to you once every 6 years or so.
One has that cycle going 30% down from our levels now. I'm just wondering if you were in that camp.
That certainly wouldn't surprise me with the current setup. With this type of thin market, using my model, the Elliott Wave model, it's typical of a B wave or a very weak fifth wave.
Okay.
So I think we're deep into that. In the meantime, you've got China leading the way down. It's down 25%. It's very similar to what happened in 1928 when the British stock market topped out a year ahead of the U.S.
So let me ask you about debt. You've been worried about it, that we're in for some sort of problem there. I think Jamie Dimon had been among those say we're about to, I don't want to mischaracterize them, fall off a debt cliff. But you're in that position, too, that there are bills coming due and we won't be able to pay them.
Yeah. Now, take a look at what's happened with the Fed. Back in 2008, we had $0.8 trillion worth of base money. And the Fed created so much new money that by 2022, that had gone up 1,000% to nearly $9 trillion. Well, what's interesting in the recent year is that the Fed has actually taken an active stance to reduce the base money supply. It's come down, I believe, more in that period of time than any time in history. Now, the last time we had a little relaxation in the total money supply was 2019. And the stock market struggled to hold up until February 2020, and then it finally fell 35% in 5 weeks. So it's kind of fighting headwinds here with the drop in the money supply. And when you get that, along with record debt and junk bonds yielding only 2% more than 90-day Treasury bills, which is another indication of ridiculous optimism, I'd say you're in a situation where safety should be paramount.
As I'm looking at the office behind you, maybe I'm not making it out clearly, but over your left shoulder, is that a statue or a little doll of Donald Trump?
Oh, no, that's not Trump. That's the Diamond Hands kid.
Oh, okay.
You know,
I was just going to say, you didn't strike me as a, I don't know. I should characterize your politics. But what is your sense of this election year, and would it make a difference if Donald Trump comes in, Joe Biden stays, assuming they're the nominees? How do you play that?
My colleagues and I did a study back in 2012 of 200 years of U.S. presidential re-elections. We found that the stock market was an extremely good predictor of who would get re-elected if they were already the president. When the stock market was up in the 3 years prior to re-election time, they would tend to win, and when the stock market was down, they would tend to lose. What's interesting here is we have this crazy dichotomy we've been talking about. We've got some new highs in the S&P and the Dow, but meanwhile, the broad list is still down virtually 20%. We track the presidential popularity, and the current president's popularity has been tracking the Russell 2000, not the Dow. So I think that is probably going to remain, particularly given the current environment and the background we have in the stock market.
So if you look at general market averages, that would be good for Joe Biden. If you focus on the Russell, that would be bad for Joe Biden.
All I can say is his approval rating has been tracking the Russell very closely. I think that's likely to continue. So given my outlook for stocks, I doubt that he's going to increase in his level of popularity. But that's, that's a guess. We'll let our indicator tell us.
Yeah, and I know you say you don't really focus on politics. This crazy war and everything that's going on there, the markets have ignored that, but you're saying that's not whatever factors into your kind of bearish call here. That's just noise.
No, it's actually, we look at all kinds of cultural things, and war is very important as well. I mentioned earlier that under my Elliott Wave model, I think we're in a B wave or a very weak fifth wave. Well, you remember 1968, you had the Value Line Index making new all-time highs as late as December 68. Meanwhile, we had a raging war and escalation in Vietnam, and people were wondering why stocks were going up. But stocks are there to fool people, and they do tend to go up, usually in a thin manner when you're in this kind of environment culturally.
You know, I love having you on, not necessarily for the things you say, but like Peter Eliades, another, I guess you'd call him the substantial bear, an iconic one. They look at data and things that a lot of average folks miss, and you should factor it in. And you don't have to be a member of Mensa like you are to look at it. So, Robert, thank you very, very much.
Well, you know what?
Go ahead.
The few of us left in the technical analysis community appreciate the fact that you have us on now and then. So you have a great day, and same to your viewers.
All right. Well, after hearing what you just said, I don't think they're looking forward to a great day, but they had to hear fair and balanced. That's what you just did, Robert. Thank you very much. Always good seeing you.
As long as they stay safe. As long as they stay safe, I think they'll be happy.
Yeah, there are a lot of safe havens out there. The money market account, we get paid more than 5%, not too shabby.